Welcome to my channel, Why Trend Money, where we share essential financial knowledge with you. Ever wondered which Vanguard ETFs Warren Buffett believes you should buy and hold forever? Today, we're diving deep into Buffett's top picks, 8 Vanguard ETFs that promise long-term growth and stability in your investment portfolio. Have you ever thought about investing in ETFs that offer a blend of growth potential and stability without the hassle of picking individual stocks? Stick around as we uncover each ETF's composition, benefits, and why Buffett sees them as timeless investments. By the end of this video, you'll have a clear understanding of how these ETFs can fit into your investment strategy, whether you're aiming for growth, income, or international diversification. Plus, we'll discuss the latest news impacting these ETFs, ensuring you stay ahead in today's dynamic market. Ready to explore the world of Vanguard ETFs handpicked by Warren Buffett himself? Subscribe to our channel and hit the bell icon so you don't miss out on our latest insights into the world of investing. Alright, let's start with Vanguard Total Stock Market ETF, or VTI for short. This ETF is like a giant basket holding a piece of every major company you can think of in the United States. Imagine it as a snapshot of America's entire economic landscape. When you invest in VTI, you're not just buying shares of one or two companies, you're investing in hundreds, no, thousands of companies that make up the heart and soul of America's business world. We're talking about big names like Apple, Google, and ExxonMobil, but also smaller companies that are quietly making their mark in industries like healthcare, retail, and technology. The beauty of VTI lies in its diversity. It spreads your investment across companies of all sizes, from the behemoths of Wall Street to the promising startups on Main Street. This diversification helps spread out the risk. If one sector, say technology, has a rough patch, the gains from other sectors like healthcare or consumer goods can help balance things out. Over the years, VTI has shown that it can weather storms and still come out strong. Whether the market is up or down, this ETF aims to reflect the overall performance of the U.S. stock market. It's designed to capture the growth of companies large and small, giving investors a piece of America's economic engine without having to pick individual stocks. Plus, investing in VTI is cost-effective. The fees are low, which means more of your money stays invested and working for you. It's like paying less for a ticket to the big show on Wall Street. So why does Warren Buffett like VTI? Well, he believes in the power of the American economy over the long run. By holding a piece of VTI, you're essentially betting on America's ability to innovate, grow, and prosper over time. In summary, VTI offers a straightforward way to invest in the entire U.S. stock market with one simple purchase. It's a diversified, cost-effective option for anyone looking to build long-term wealth without getting caught up in the ups and downs of individual companies. Now, let's zoom in on VOO, which Warren Buffett often highlights for its simplicity and effectiveness in capturing the essence of the S&P 500. Imagine the S&P 500 as a lineup of America's 500 largest publicly traded companies, covering a wide range of industries like technology, healthcare, finance, and more. VOO essentially lets you own a piece of this entire lineup in one go. Why does Buffett favor VOO? Well, it's like getting a ticket to the biggest companies driving the U.S. economy. Think Apple, Microsoft, and Google, all in one investment. These companies are household names with a track record of success, making them stable anchors in your portfolio. What sets VOO apart from other ETFs? For one, it mirrors the performance of the S&P 500 index, which is often seen as a benchmark for the broader U.S. stock market. By investing in VOO, you're not betting on just a few stocks, but spreading your risk across a diversified basket of top-tier companies. This diversification helps smooth out the ups and downs that individual stocks can experience. Another perk of VOO is its low expense ratio, which means you pay minimal fees to invest. This cost-effectiveness is crucial for long-term investors looking to maximize their returns without sacrificing quality. Plus, VOO is highly liquid, meaning you can buy and sell shares easily on the market, ensuring flexibility in your investment strategy. When it comes to performance, VOO has historically delivered solid returns over the years. It tracks the S&P 500 closely, capturing both the highs and lows of the market. This consistency makes it a favorite among investors who prefer a steady, reliable approach to wealth accumulation. In summary, VOO encapsulates Warren Buffett's preference for straightforward, high-quality investments. It gives you exposure to America's corporate giants, offers cost efficiency, and historically performs well in various market conditions. Whether you're starting out or refining your portfolio, VOO presents a compelling case as a cornerstone ETF for long-term growth. All right, let's take a trip beyond our borders with Vanguard's Total International Stock ETF, also known as VXUS. This ETF is like your passport to global markets. It doesn't just focus on the US, but dives into a world of opportunities across developed and emerging economies. Imagine VXUS as your gateway to owning a piece of companies from Europe, Asia Pacific, and beyond. It's like having investments in Toyota from Japan, Nestle from Switzerland, and Samsung from South Korea, all in one fund. VXUS spreads your investment dollars across thousands of stocks, giving you exposure to diverse economies and industries. Why go international? Well, think of it this way. While the U.S. economy is massive and powerful, other countries also have their own strengths and growth potential. By investing in VXUS, you're not putting all your eggs in one national basket. You're diversifying, spreading your risk across different regions and currencies. Now, how has VXUS performed historically? Actually, quite impressively. Over the years, VXUS has shown resilience through various market conditions. It's participated in global economic growth spurts and weathered storms in international markets. This ETF is designed for long-term investors who believe in the power of global diversification. But wait, why should you care about international stocks? Well, they offer unique opportunities that might not be available in the U.S. alone. Emerging markets, for example, represent economies with rapid growth potential due to factors like young populations and expanding consumer markets. VXUS captures these opportunities, helping you benefit from global economic trends. Keep in mind, though, international investing isn't without risks. Currency fluctuations, geopolitical events, and regulatory changes can impact your investments. That's why VXUS isn't just about potential rewards. It's about balancing risk and reward in a globally interconnected world. VXUS isn't just another ETF. It's your ticket to a diversified global portfolio. Whether you're bullish on European tech startups or Asian manufacturing giants, VXUS lets you participate in the growth stories of economies around the world. Consider adding VXUS to your investment mix if you're looking to broaden your horizons beyond U.S. borders. Now, let's take another journey beyond U.S. borders with Vanguard's FTSE All-World ex-US ETF, commonly known as VEU. Imagine this ETF as your passport to global markets, excluding the United States. VEU isn't just about Europe or Asia. It's a comprehensive basket of stocks from over 50 countries worldwide, giving you a slice of international economic diversity. Why look beyond the U.S.? Well, diversification is like having a variety of ingredients in your investment stew. It helps balance out the flavor, reducing the impact of any one country's economic ups and downs. VEU spreads your investment across developed markets like Japan and the UK, as well as emerging markets like China and Brazil. This mix taps into different stages of economic growth and market opportunities. Think of it this way. While the U.S. economy is a powerhouse, other countries offer unique growth potentials. For instance, emerging markets often have younger populations and increasing consumer spending, driving local companies forward. Meanwhile, developed markets provide stability and established industries, offering a blend of growth and resilience. VEU tracks the FTSE All-World ex-US Index, which includes thousands of companies ranging from multinational giants to local champions in their respective regions. This diversity not only spreads risk, but also opens doors to sectors and industries that may not be as prominent in the U.S., like automotive innovation in Germany or renewable energy in Scandinavia. Over the years, this ETF has shown resilience through market cycles, reflecting the interconnected nature of today's world markets. While international investments carry risks, VEU's broad exposure and Vanguard's reputation for low-cost investing provide a compelling case for long-term investors looking to broaden their horizons. So whether you're seeking growth opportunities in emerging markets or stability in established economies, VEU offers a well-rounded approach to international diversification within your investment portfolio. It's like having a diversified team of players from around the world, each contributing their unique strengths to your financial game plan. Now, let's jet off to explore the Vanguard FTSE Emerging Markets ETF, or VWO for short. This ETF focuses on the exciting world of emerging markets, which are countries with rapidly growing economies like China, India, Brazil, and many others. Imagine you're investing in the future. That's what VWO is all about, capturing the potential of countries that are on the rise, where industries are booming and new opportunities are constantly emerging. Emerging markets often have younger populations, increasing urbanization, and a hunger for innovation. Companies in these regions are often at the forefront of technological advancements and consumer trends, making them compelling investments for growth-oriented investors. Now, why does Warren Buffett keep an eye on these markets? Well, despite their potential for high growth, investing in emerging markets comes with its share of risks. Political instability, currency fluctuations, and regulatory changes can impact these economies more than developed ones. However, Buffett sees these risks as opportunities when approached with caution. VWO gives you exposure to these markets while spreading out risks across a diversified portfolio of companies across various sectors like technology, finance, and consumer goods. For example, think of the rapid expansion of e-commerce giants in countries like China, or the innovative advancements in healthcare and biotechnology in India. VWO puts you right in the midst of these dynamic growth stories. When you invest in VWO, you're not just betting on individual companies, but on the potential of entire economies to thrive and expand. It's like planting seeds in fertile ground and watching them grow over time. Historically, VWO has shown both promise and volatility, reflecting the ups and downs of emerging market cycles. It's important to have a long-term perspective when investing in VWO, understanding that these markets can experience sharp fluctuations, but also offer substantial rewards for patient investors. VWO is your gateway to capturing the growth potential of emerging markets in a diversified and manageable way. Whether you're looking to add some spice to your portfolio or capitalize on global trends, VWO offers a unique opportunity to participate in the next wave of global economic growth. Let's talk dividends. The Vanguard Dividend Appreciation ETF, or VIG, is all about companies that love to share their success with shareholders. Imagine investing in companies that not only make profits, but also regularly increase the amount they pay out to their investors. That's what VIG is all about. Putting your money into firms known for their strong commitment to growing dividends over time. Why does this matter? Well, dividends are like a little bonus check that companies send you just for being a shareholder. They're a sign of financial health and stability because only companies with consistent earnings and strong cash flow can afford to dish out dividends regularly. Now, VIG doesn't just pick any company that pays dividends. It focuses on those with a track record of not just paying dividends, but increasing them year after year. These companies are often leaders in their industries, with solid business models that weather economic ups and downs. Investing in VIG means you're betting on companies that have a history of taking care of their shareholders. These firms tend to be more resilient during tough times because their steady cash flow allows them to keep those dividends flowing, even when the broader market might be shaky. So who are these dividend champions in VIG? You'll find companies like Johnson & Johnson, Microsoft, and Visa. Household names known not just for their products and services, but also for their commitment to rewarding shareholders. When you invest in VIG, you're not just chasing high-flying stocks that might crash and burn. Instead, you're building a portfolio with companies that have a history of steady growth and a commitment to sharing their success with you, the investor. It's like building a foundation with bricks made of solid, reliable companies that stand the test of time. And here's the kicker. Dividends aren't just extra pocket money. Over time, reinvesting dividends can significantly boost your overall returns. It's like planting seeds that grow into even more money over the years, thanks to the magic of compounding. Warren Buffett himself appreciates the power of dividends. He often advises investors to focus on companies that pay dividends because it's a sign of financial discipline and shareholder alignment. By choosing VIG, you're following in Buffett's footsteps, investing in companies that not only grow, but also reward you for your loyalty as a shareholder. In a nutshell, VIG isn't just about dividends. It's about investing in companies that have a proven track record of financial stewardship and shareholder value. Whether you're looking to build wealth for retirement or generate passive income, VIG offers a compelling option for investors seeking stability and long-term growth. All right, let's talk about Vanguard Growth ETF, or VUG. This ETF is all about chasing growth, finding companies that are expanding quickly and driving the future of their industries. Imagine you're investing in the companies that are always pushing boundaries, innovating, and growing their profits. That's what VUG is designed to do. It targets companies across sectors like technology, healthcare, and consumer goods that have the potential for rapid earnings growth. Why would you want to invest in growth stocks like those in VUG? Well, think of it this way. These companies are often at the forefront of change. They're the ones introducing new technologies, disrupting old ways of doing things, and capturing market share. For example, think of tech giants like Apple or Amazon. These companies started small but grew rapidly as they revolutionized how we communicate, shop, and entertain ourselves. By investing in VUG, you're getting a piece of these success stories. Now, growth investing isn't without its risks. These stocks can be more volatile because their prices often reflect higher investor expectations for future earnings. However, if you're willing to ride out the ups and downs, the potential rewards can be significant. VUG isn't just about any growth stock, it's about quality growth. Vanguard selects companies for VUG based on their strong potential for earnings growth and leadership in their respective sectors. This means you're investing in companies that not only have big ideas, but also have the ability to execute them effectively. One of the key advantages of VUG is to focus on companies with a proven track record of growth. These are companies that have consistently outperformed their peers in terms of revenue growth and profitability. By investing in VUG, you're tapping into a portfolio of companies that are not only growing now, but have the potential to continue growing in the future. When you think about growth investing, you're looking for companies that have the potential to grow into giants, much like how a small sapling grows into a towering tree over time. VUG aims to capture that growth potential and translate it into long-term gains for investors. So, if you believe in the power of innovation and want to be part of companies shaping the future, Vanguard Growth ETF, VUG, could be an exciting addition to your investment portfolio. Just remember to balance your investments according to your risk tolerance and long-term financial goals. All right, let's dive into Vanguard's Value ETF, VTV, which aligns perfectly with Warren Buffett's approach to investing in undervalued stocks with solid potential. Buffett's strategy revolves around finding companies that are trading at a discount compared to their true worth. This isn't about chasing the latest hype or trends, but focusing on companies with strong fundamentals that might be overlooked by the market for the moment. What makes VTV special is its selection of stocks that are considered undervalued based on metrics like price-to-earnings ratio and price-to-book ratio. These metrics help identify companies whose stock prices might not reflect their true value, presenting an opportunity for long-term growth once the market catches on. When you invest in VTV, you're essentially buying into companies that have a proven track record and stable earnings, but are currently priced lower than what their financial health suggests. These are often established firms with strong market positions and consistent performance through various economic cycles. The ETF includes companies across various sectors that fit the value investing criteria. You'll find companies that are leaders in their industries, but may have temporarily fallen out of favor with investors. This could be due to short-term challenges or market sentiments that don't fully appreciate their long-term prospects. For example, VTV might include companies in sectors like utilities, healthcare, or consumer staples, industries known for stable demand regardless of economic conditions. These companies typically offer dividends as well, adding another layer of attractiveness for investors looking to generate income alongside potential capital appreciation. Buffett's philosophy behind value investing is all about patience and discipline. It's about buying quality companies at reasonable prices and letting time and compounding work their magic. By investing in VTV, you're not only aligning with Buffett's timeless principles, but also positioning yourself for potential growth as these undervalued stocks regain favor in the market. Remember, value investing isn't about quick gains or flashy returns. It's about steady, sustainable growth over the long haul. By including VTV in your portfolio, you're adding a layer of stability and value that complements growth-focused investments, helping you achieve a balanced approach to wealth accumulation. So, if you're someone who values stability, consistent returns, and a methodical approach to investing, Vanguard's Value ETF VTV could be a solid addition to your investment strategy. It's all about investing in companies with strong fundamentals that the market might be underestimating, a strategy that has stood the test of time in Buffett's playbook. And there you have it, Warren Buffett's top picks among Vanguard ETFs that you can buy and hold forever. Whether you're drawn to domestic growth, international diversification, or income-focused strategies, these ETFs offer something for every investor's goal and risk tolerance. Remember, investing is a journey, not a race. By understanding the fundamentals and aligning your investments with a long-term strategy, you can build wealth steadily over time. If you enjoyed today's video, don't forget to like, subscribe, and hit the bell icon for more insights into the world of investing. Thanks for watching, and until next time, happy investing.